Let's welcome yet another guest. Ajay Srivastava, the CEO of Dimensions Corporate Financial Services, joins us. Good morning, Ajay. Another very difficult morning of trade. Do you think we may have a worse morning because we have to cream off yesterday's excesses?
Well, luckily, we have become so used to the huge negatives. So I think this 200 points doesn't sound to be a great calamity for the Indian market. I think we have seen much worse. And that's what gives us a little more comfort that I think compared to the rest of the world, Lata, I believe that we have sold off so badly in the last 1 week or so that we are far better able to handle this downturn than perhaps we would have been in normal circumstances. So I'm not too worried today as to what's going to happen. Yeah, maybe we may give off 100, 200 points, but it's not going to be as maddening as it was in the last few weeks that we have seen in the market. So yes, it's a problem. And the good part of the problem is that at least there is, we got a political response straight away from the U.S., which talks to interest rate. And it also tells you very clearly that RBI will have to come out very quickly and raise the interest rates. You've seen the U.S. yield last night. They were spiking beyond 3.2%. So there is no way RBI cannot now come and raise the rates very soon. And it will be quite embarrassing, actually, that within a 1 week or 2 weeks of the policy, they'll have to come back and do the rates. So I think rate increases on the cards in the immediate horizon.
Okay, rate increase on the cards. Ajay, good morning. But
good morning.
So much in terms of gains have been wiped out in such a short while that the sentiment has gotten really punctured, especially from the retail fraternity. What is your advice to retail investors now?
See, at this point of time, I think just sit with your position. There's nothing to be done. If you sell out, you're going to have the seller's remorse very soon. If you buy, you have buyer's remorse immediately. So I think you have a choice between having a deferred seller remorse and an immediate buying. So I think you just stay put, stay quiet, sit with your positions, and let the market do its own stuff for the time being. I think it's very difficult. I'll be honest to tell you, very difficult to take a call in this market to say, are there immediate gains available? Are there immediate losses available? Both can happen. But I guess we are at a stage where with the oil prices the way they were last night, I think we should be okay.
Something,
Ajay, good morning. So, what should investors be doing, especially the ones who have bought right at the highest level? Because, this morning also, a lot of people asking what should the approach be? Is this still a good time to be putting more money into the decline, or should the strategy be different now?
No, of course not. I don't think so. You should be putting more money. But, look at the world market. Look at what's happening to the US dollar. Look at what's happening to India's GDP growth. IMF has already come back and said world growth has been cut. India's GDP will not be 7%. So there is no compelling case to buy any equity today. I think we just need to wait a while, keep the cash in hand. Your debt yields are not bad at all. And if you look at it now in hindsight, our 3-year debt yields are now becoming better than what equity has given. So I don't think so. This is a good time. You're getting 8% at FD rates. Sit quiet with it. Let this whole thing settle down, because India's festive season also is not looking very good at this point of time. So the triggers which were to buy are absent in this market, and there is no need to average out. I think the temptation is average out. I guess hold on to your averaging out tendency and let's wait a while. The only other thing I must say is, if you've got banks, do not sell out. I think the banks are going to come out clear winners in all this chaos. Therefore, if you don't have banks, buy banks. If you have banks, stay put.
How about switching from NBFCs to banks?
Lata, the question I think Anuj asked is that how much of the damage that you've done to your portfolio already with your NBFCs. I think that's where your switch point is. So if you're really in a bad shape, you hope to hell that you recover it. Banks will give you 20% return. They won't make you 30, 40% return. Re-rating NBFCs in a manner of mergers and acquisitions, I think that could be a big trigger. Some of the NBFCs applying for banking licenses now could be another big trigger. So I would say wait with NBFCs, because the two triggers of re-rating, mergers and application for becoming banks might give you a decent rate of return compared to getting out now and getting into banks.
Okay.
They'll get licenses after the recent experiences. Anyways. Yeah, sorry, Sonia.
No, I just wanted to ask him, you said that banks is the place to be. Perhaps, it could emerge as a winner. What about other spaces, maybe something like autos? All these stocks are at 52-week lows now. Demand has softened, but it's not gone away entirely. You think some of these stocks are good buys?
I think for time being, I'm sorry, Sonia, what we are seeing on the demand side in the market is very, very bad. Okay. It's not looking good at all. So I think let's stay clear of auto for the time being, because environment is very, very hostile to them. Basic demand is very low. Interest rates are spiking. So, the EMI, the way middle class looks at it, how much EMI can I afford? That is becoming a problem today. You already saw HDFCs raise money at a historic high in the last 3 years. if they raise at this rate, can you imagine what's going to happen to the rest of the market? So you're going to see interest rates spike. You're going to see higher EMIs. And therefore, I think people will not really get tempted to buy on EMIs at this stage and manage what they have, because every EMI now is going to go up in the next 30 days,
so
whether it's a housing loan, car loan.
So the strategy should be part of your money in bank FDs then, and part of your money in bank shares.
Both ways it works, because you put your money in the FDs, it works very well. Bank shares, I think, will work very well. You know, Lata, at this point of time, you're looking at safe havens. You're looking at financial pockets where there is no major surprises, hopefully should come around. And that is where banks give it. That's why I said bank FDs first and bank stocks later.
Okay. You know, Ajay, even TCS has corrected 10% rather swiftly. It comes out with numbers today. You reckon that that also needs to correct, or is this going to be still a safe haven in this kind of environment?
No, I think it's a safe haven. I think it's been corrected also because I know a lot of people we know in the market have also sold off their best holdings, booked profits, given margin calls, etc. So there's been deleveraging process, there is a sell-off process, there is a profit booking process. And, you know, when you need to pay margins, you don't care what stocks you're selling. You're selling what best you got in the portfolio and what gets the best price. So what's happening in the last 10 days in IT stocks has been a major shift that, listen, let's book our profit because they've been sitting on profits. Let's stay out of the market. And, you know, these are easily sellable stuff. You can't sell those mid-caps. They're all on the circuit filters. So I would say TCS and Infosys and all the sectors, keep holding on to it. If there's a major correction, buy it back. They'll give you fancy returns because now the hedges are going to start to play for the next year financials. Next year financials are going to show returns of 75 rupees and above compared to 65 rupees in this year conversion rate post the hedges. So you're talking of 15% increase in realizations for the next year automatically booked in by these companies.
Okay, so you're saying, you also said earlier that keep cash in hand, there are no triggers to buy. So is this officially the start of a bear market, you think, or are we still in a bull market?
Of course not. We are not in the bull market by any measure. And I think the reason I say so is not only because of stock market. You look at the real economy. Nobody's feeling bullish. You saw the car numbers, two-wheeler numbers, auto numbers, cement numbers, steel numbers, Tata Steel numbers. Nobody is bullish. The volume increase are 2% and thereabouts. So I'm not sure where GDP growth numbers are coming from, but I'm certainly sure that the real economy is in a bear market. Forget the financial economy.
All right. Ajay, thanks a lot for joining us.